The COVID years of 2020 and 2021 has seen a large number of companies, in fact, almost 100 companies issuing IPOs in the primary market, raising capital in excess of 5 lakh crores from various investors in the country. Hello, everybody, and welcome to my YouTube channel. I'm your learning partner, Sushila Hariharan, and we're going to take a look at what has created this frenzy in the IPO market. While some of them have listed at bumper gains, some of them have flopped so miserably, and a few of the IPOs have also been culled because of not having received enough number of subscriptions. So in this video, we're going to take a look at a specific product called as IPO loans. Loans that are given by banks, NBFCs, that is non-banking finance companies, as well as fintech companies to individuals to apply for IPOs. We will also take a look at what are these loans structured as and how is the loans to be repaid. Loans given to investors for applying for an IPO. So why would investors want to take a loan for applying for an IPO? It is very simple. The way the IPO market works is that the investor has to make an application for the IPO. Okay, if they make an application with their own money, then they're able to get allotment up to a small amount. But if they use their own money plus the loan money, then they're able to get the chances of getting application allotment is very, very high. So the IPO allotment market or the IPO allotment system is a little weird in the sense that while there are quotas and sub-quotas created for different categories of investors, within each sub-quota, within each sub-segment, how much is the probability of an investor getting allotment is a little difficult to predict. Therefore, what investors do is they try to apply for as much as they are allowed to apply for. All right. And that's where this product comes in. That is the IPO loan. The IPO loans which are offered by even online brokers like Sharekhan and IIFL allow us to apply for an amount that is much higher than what our own capital is available for. Okay. What do you think? Are these loans given for short term, medium term, or long term? Now, what is the intention of the investor who is taking an IPO loan? The intention of the investor who's taking the IPO loan is to get allotment, okay? Is to increase his chances of getting allotment at the IPO. If you look at an IPO tenure, okay, starting from the issue date to the allotment date is a period of about 14 to 15 days. Okay, and about 2 to 3 days is a gap for listing. So if you look at the total period is about 17 days. So therefore, the investor who's applying for the IPO loan only is keen to make a very short-term profit. The profit between listing price and issue price. That is very clear. Therefore, IPO loans are given for a very short term. In fact, most of these loans liquidate within a period of 30 days. Okay, they have to be repaid within a period of 30 days. Look, the investor's intention itself is only to make a profit on listing. If that is the investor's intention, even if the investor gets allotment, his intention is not to keep the loan forever. Okay, his intention is to repay the loan, is to sell the asset that is being financed and book that profit. The profit of a few days between the listing price and the issue price is what the investor is looking out for. Since that profit exists only for a brief period of time, the investor is also going to take a loan for only a very short period of time. Is it a secured loan or an unsecured loan? So how this works? The loan itself is given against the security of the shares that will be allotted. So the investor who's taking a loan is applying for the IPO, and when they apply for the IPO, they're going to get a collateral, right? They're going to get an allotment of the shares. That allotment of shares itself works as a collateral for the lender. What happens if the investor does not get? The investor takes a loan but does not get the allotment. No problem. Automatically, the money is diverted back to the lender. Okay, so the investors' money is used only for the purpose of getting allotment. If allotment is not got, then there is no release of funds by the lender. Therefore, the lender has no collateral. There is no worry at all because no loan has been disbursed. And the most important point about the any lending product, that is what is the LTV, that is the loan to value ratio. Now, loan to value ratio in the case of IPOs is very, very high. Okay, that means almost a 50% margin is kept by the lender. Why do lenders keep 50% margin? Because there is too many uncertainties in an IPO. If you take a look at it, there are three main uncertainties. The first one is what would be the listing price. Second one is what is the probability of getting allotment. Third one is after listing, will the price stay high so that the investor can sell off? In order to meet these three investment criteria, the LTV margin is normally very high. I checked a few banks and found out that their LTV margin was almost 50%. That means if you're applying for shares worth 1 lakh, you will be given a loan worth only 50,000 rupees. How does an leveraged IPO application help the borrower? A borrower or the investor is very keen on getting an allotment. In an IPO market, the chances of getting allotment is higher if you apply for a larger amount. So SEBI has taken care of many criteria like the criteria of quotas and segments and subsegments, etc. But higher the application amount, higher is the probability of getting the allotment. The whole intention of taking a loan for the IPO is to get a allotment. And the second criteria is to sell on allotment, on listing. Therefore, investors, especially during crazy bull runs that we have seen, we had it during the Harshad Mehta time, we had it during 2000, 2001, we had it again during 2013, 2014, and now again. That when there is a everybody is applying, many companies are coming out of the IPOs, every investor is applying for the IPO market. The probability of getting allotment in a particular IPO is low. Okay, therefore, in order to increase your chances of getting an allotment, the rule has somehow become, okay, it's not actually a rule, but it's more like a norm, that higher you apply for, greater is the chances. With only your own funds, the investor has lesser money for application. He is limited. It has got capital. His own capital is constrained. Okay. Whereas with borrowed funds plus own funds, that is the power of leverage, investor can apply for greater number of shares. And these 2 points were the main bone of contention between why India's largest fintech player, the founder of India's largest fintech company, okay, had such a public war with a wealth manager of a private bank because they wanted to apply for the IPO of a particular company, and they were not they were able to apply for much lesser compared to what they could have applied for had they got the loan from the private lender. The greater the application amount, probability of allotment increases. And therefore, many investors, especially the serious HNI investors, UHNI investors, that is the ultra high net worth investors, leverage extensively so that they get a chance to apply for the IPO and get a chance to get the allotment for the shares, because that is the tricky portion of getting a shares in an IPO, which is extremely strong, which is extremely powerful, which is very popular amongst the investors. How are IPO loans repaid? IPO loans are repaid normally within 30 days of allotment. Okay, as already explained, the investor's main intention of taking an IPO loan in the first place is to sell the shares on listing. If that is the intention, then as soon as the shares are allotted and if they list at a higher price, then the investor has made money. Normally, allotted shares itself are sold to repay the loan. Since margin kept is normally 50%, I already explained that LTV ratio is 50%. Margin kept is 50%. If listed price is greater than IPO price by at least 50%, double, then investor makes a phenomenal amount of ultra short term profits. This is exactly what happened with investors in Nika and many other companies, where the shares have listed at hefty premiums compared to the issue price. But what would happen if you had invested in a company whose listing was much below the issue price? So you've borrowed money, you've got allotment, but you've made a loss. So I've already made a video on leverage, whether it's a dost or a devil. Take a look at that, because leverage will work profitably for you only if you are borrowing money to invest in an asset whose value is increasing. If you have borrowed money and the value of the asset decreases, then leverage has been a big flop for you. In fact, it's a burden for you. It's a devil for you. It has ruined not only your existing portfolio, it has eaten away because it comes at a steep cost. Sometimes, in some cases, almost 16-17% per annum is the cost of the IPO loans. Thank you very much for listening in. If you would like to see more videos like this, please do comment and share with your friends. These videos are very useful for people, especially now that it is campus placements time, to explain to invest to your interviewers, to enable to show off your understanding of finance and capital markets. Thank you once again.